So we're going to look today at not just the market reaction to all these tariffs, but also look at one of the real reasons why all of this is happening. And it's quite simple when you think about it. So yes, tariffs have been put on yesterday, Liberation Day. A lot of tariffs put on the board. Yes, tariffs historically are not good for countries. So that is what it is. But if we look at the bigger picture and we look at the aim of what Trump is trying to do, and the US has a lot of debt, 36 trillion for argument's sake. Now, I believe about 8 or 9 trillion of that has got to be refinanced within the next 18 months. So, in order to do that, what they're trying to do is they are trying to have a lower bond yield, which means that when it comes around to refinancing, that hopefully the USA will save a hell of a lot on interest payments. That's the idea. So if you are trying to achieve that, how do you go about achieving that without telling people that's what you're trying to do? Well, what you can do is try to tank the markets in some way, shape, or form. Fair to say that so far, so good from that point of view. If you're then trying to tank the stock markets, what you're going to do is push people into bonds, which then inversely drops the yield. So if we look at when Trump took office in January 2025, so a couple of months ago, the 10-year US Treasury yield was at 4.79%. At the time of recording this, it's about 4.17%. Now, 0.62% might not sound like a lot, but when you're looking to potentially refinance trillions, that's a lot. So I think that's what this is all about, personally. It is trying to get those bond yields lower in order to refinance $8 or $9 trillion of debt at a lower level. Once that's been achieved, then I'm not just going to say it's happy days, but I think that's what all of this is about. So that's why we've seen things like tariffs being put on. I mean, if I look at the markets today, I mean, some ridiculously big drops. You could argue maybe those drops have been overblown. I mean, looking at the numbers at the moment, Wall Street or Dow Jones, sorry, down by about 1,300 points, 3.1% drop. The Nasdaq down about 450 points, give or take. That's 2.4%. If you look at the S&P 500 as well, that's down about 155 points. That's about 2.8%. Over in Europe, FTSE 100 down by about 75 points. It's about 0.9%. The DAX over in Germany down by 365 points. It's about 1.66%. I'm just going to have a look at the Nikkei in Japan. Yeah, that's down by about 1,120 points. It's about 3.25%. So across the board, the reaction hasn't been good. Even in silver's had an absolute shocker of a day. I mentioned about a silver squeeze a little while ago. Silver's had an absolute shocker. So I'm just getting my stats up. Give me a second. Yes, silver's had an absolute mare today, down by about 6.2%. So it's down by about $2, $2.10. The only thing, or a couple of things that have held up relatively well, before I say that, I should say that even Brent crude is down by over 5%. Two things that have held up relatively okay today would be, number one would be gold. Now, gold is down about 0.8%, down about $26. Overall, it had a bit of a sharp pullback in European trading and early American trading, but it's doing all right in comparison to everything else. And then natural gas, using the Henry Hub, US dollar numbers. That's up by about 2.3% today at the time of recording. So not everything's fallen off a cliff. The biggest thing I think that's gone up today is the VIX index. Obviously measures volatility. That is up by just over 20%. So crazy stuff going on at the moment. Now, for those that follow me, you'll know that I'm calling for a blow off top anyway. I still haven't changed my mind given everything that's happening. One reason for that is that although the Fed, they're damned if they do, damned if they don't, I still think they're going to play a big role moving forwards. Now, are they going to come to the rescue? The chances are they are going to come to the rescue. But as we've seen before, and as history has told us, all that does is add fuel to the fire. So, will they have an emergency meeting between now and May? I don't know. I'm not the Fed. Chances are, though, in May, they will cut rates. And then that's why I think, stock markets are just going to have a blow off top. Once that happens, then it's a case of watch out below. Now, I'm not perfect. I could be completely wrong on that. It is a contrarian view. There's not many other people out there that are saying the same thing. Now, a lot of people yesterday, will look at Trump, will look at tariffs, and we'll look at all of that. However, what we must remember is if the aim of all of this is to lower the 10-year treasury rate, then they are doing exactly that. Now, how they go about that, we might not necessarily agree with, but we have to look at the bigger picture and go, if that is the aim to lower that rate, then they're doing a very damn good job of doing it. I don't know if the Fed's going to come in and rescue the stock market and rescue Wall Street. I mean, it's happened before. The chances are it's going to happen again. But I don't really know, to be honest. The only people that will know that are probably the Federal Reserve. That being said, what we're going to do in the next couple of weeks is a couple of podcast guests that are on. Dr. Naomi Prinz is returning to the podcast. So we're going to talk about a lot of this stuff more in depth next week. Also, Doomberg, who you will probably be aware of, everyone's favourite green chicken. He's coming back, or the Doomberg team are coming back next week as well. So we're probably going to be talking all things oil, natural gas, resources, like we did last time. We'll do a whistle-stop tour around the world. There's a lot of crazy things going on out there at the moment, but if we play our cards right, then the chances are we're going to come out of the other side in better circumstances. Now, I'm not an IFA. I can't make financial recommendations or financial advice. I'd always say to people, if you do not yet have a position in physical gold and physical silver, then I'd recommend you go and do your homework, do some research, and then make a decision that works for you. On the Contrarian Capitalist next week, there's going to be some, or in the next couple of weeks, there's going to be some written content to do with the history of gold, looking at the correlation and things to do with Great Britain, the United Kingdom, gold, trade, how gold has reacted in uncertain times, looking at that from an historical perspective. If you're yet to read the article about the gold and silver ratio, I wrote that came out on Wednesday the 2nd, and that looks at a potential arbitrage play in silver and platinum, about how you could potentially buy those metals and then take advantage of those ratios decreasing in relation to gold. Again, that's not that's not a financial recommendation, but do go and read that article because that's something I'm going to be looking to do moving forwards. So hopefully that helps. So just bear in mind with the tariffs, it's not necessarily all about the tariffs. We've got to look at the bigger picture, and if that's to bring down that yield number, then they're doing that very, very well. In order to do that, you're going to need to take some heat out of the stock market, which is exactly what they're doing. So, if that was the aim at the start, then congratulations, that's what they're doing. And also, that they've said before, Scott Bessent has said before, they're looking to monetize the asset side of their balance sheet. One way that they could do that is to potentially revalue gold. I thought they might do that yesterday, but they didn't. However, again, if you're trying to create uncertainty in the stock market, bring those bond yields down, uncertainty and stock markets don't go well together. So capital flight takes place, then that capital flight or that capital, chances are that goes over to gold. Again, what we're seeing in the gold market at the moment is a lot of Western retail. I appreciate yourselves watching this video are probably already invested in gold, but most of the generic Western retail are not even paying attention to the gold market. Once they wake up, gold, chances are it's going to go much higher. And then again, if the plan at the start was to monetize the asset side of the balance sheet and to do that by revaluing gold, well, why go out and revalue it when you can, let the market do it itself by having these policies in place? So I'm hoping that gives you a bit of food for thought. If you're yet to subscribe to the Contrarian Capitalist, please do so. contrariancapitalist.substack.com. Lots of written content, loads of podcasts on there as well. And as always, we'll be back on Friday the 4th, i.e. tomorrow. We've got a podcast out in the morning, and then also the weekly wrap for paid subscribers will be out after market close tomorrow. So hopefully all that helps. Just remember the bigger picture. If you're yet to subscribe to Contrarian Capitalist, please do so. contrariancapitalist.substack.com. Thank you very much, and see you soon.